So in this video, we're going to talk about how interest rates affect the greater economy and why they're actually important. I think before we get into the specific details of that, I should introduce this concept of the yield curve because I think visually it might be easier to understand kind of what interest rates are and how they work uh, by using a visual graphical representation. Okay, so let's imagine we have a graph here. Here we are going to have the interest rate. So this is going to be stated as a percentage. So maybe we'll have 1%, 2, 3, 4, 5. Okay, so these are all percentages. And then the x-axis is going to represent how long the loan is going to be given out for. Okay, so let's say this is going to be the yield curve for the US government. Okay, this is how much when the US government lends, how much interest they're going to pay. And how much interest they're going to pay is going to depend on how long the loan is going to be kind of outstanding for. So let's say here it's going to be 1 month. And then out here, the government issues 30-year bonds too. Okay, so when someone buys a 30-year bond, they're essentially agreeing to lend to the government for 30 years. Okay, that bond is going to be not paid back uh, for 30 years. Okay, while a 1 month treasury bill is going to be paid off within 1 month. So if you give the government $100 today, in 1 month they're going to give you that $100 back plus interest. Okay, so you would expect that this is a much less risky loan than this 30-year loan. So normally you would see something like this where maybe the 1 month interest rate is 1% and then it just kind of increases over time. Okay, so and this is as of, let's say, today's date. Okay, this is the yield curve for today, meaning that if I lent the government today for 1 month, I'll get this rate of interest. And if also today, if I lent the government money for 30 years, I'm going to make whatever this much. If we just, whatever, plotted this out here. It's not exact, but you get the idea. Okay, so what the Federal Reserve policy is controlling is just this short-term rate, okay? But this short-term rate is going to be the seed upon which the rest of this yield curve is built off of. So let's say the Federal Reserve raises this rate from here to here, okay? This is going to shift this yield curve up like this, okay? The shape of the curve also changes. So I'll give you an example. Right now, actually, this curve is inverted, okay? So that means that uh, basically, let's say this is approximately right because the short-term rate is around 5%, and actually you see this curve going down. I'm exaggerating it, but this is essentially what's happening, where the you can lend the government money for 1 month, and you'll earn a higher interest rate than if you lent the government money for 30 years. Okay, why is that? The expectation is that this rate is going to just go back down here, and so people are trying to lock in a higher rate now. They expect that this short-term rate is temporary, okay? In 1 or 2 years or whatever, it's going to go back down. And if you just kept lending the money to the government for 1 month, you'll have to keep reinvesting it. And after that year, you're only going to be getting this 1%. Okay, this is what the market is expecting. That's why this curve is inverted. So what people are saying now is like, instead of waiting for the rates to go from 4 to 5%, let me just lock in a long-term rate of earning whatever it is, 3, 4%. Okay, so they're willing to forego the short-term extra interest they're going to earn to lock in a higher rate because the expectation is that the rates are all going to go down in the future. Okay, that's why the yield curve can invert sometimes. Now, I just mentioned that this is the yield curve for the federal government's borrowing. Okay, so why is this rate important? Because a lot of the pretty much all the other interest rates for lending to other institutions, individuals, are going to be built off of this, what is called the risk-free rate, okay? Because the government, as I mentioned in the previous video, can always just create new money to pay off their debt. So, for example, a lot of real estate loans are tied to what the 10-year treasury interest rate is. So let's say in this case, it's 5%. Okay, so if the government is paying 5% to borrow for 10 years, a real estate loan is going to be some spread off of this. Okay, so now a new borrower that's more risky than the government, if the government is paying 5, then maybe it's a 2% spread off of the 10-year, meaning the real estate borrower is going to be paying 7%. Okay. Now, if interest rates change, this is again why interest rates are important. Let's say the curve went from here to here. Now the 10-year treasury is only 2.5%, but the spread is going to maybe stay the same. Okay. The spread also varies with time, but let's assume that the spread stayed at 2% for the real estate lender. So now instead of borrowing at 7, now that interest rates have gone down, we're borrowing at 4.5%. Okay. So this change in the rate that the real estate investor can borrow at is going to dramatically change the economics, the incentives to actually uh, make the investment. Okay, if you can borrow money for cheaper, it's going to make your returns as a owner potentially higher. It does have the effect of um, allowing people to pay more for the real estate because now since they're borrowing the money for less, they can pay more money to buy it. But in general, this rate is very important to investors because as it goes down, the incentive to build a project, to buy a property, it's gonna, all else equal, uh, incentivize the person to do so because now they're borrowing for a cheaper rate. Okay, so this is why interest rates are important. Not just the government borrowing, but all the rates that are kind of built off of how much the government borrows for by this kind of spread off of the risk-free rate. This is going to affect economic activity uh, in the U.S. and all over the world because America is such a large economy. Okay, so now let's get back to the presentation and talk about the importance of interest rates in the economy. Hopefully, now you have a little bit of a sense of what this is, but let's just explicitly go through them. So, the rate of interest is going to affect how much people are going to consume and how much they're going to save. So, if interest rates go up, for example, uh, not only is it going to be difficult for, let's say you want to buy a new car. If the car is $30,000 and you have a certain budget and the interest rates go up and the car loan that you're going to use to buy the car, now the payment went from $300 a month to $500 a month. Maybe that's going to make it past your budget and you're not going to be able to afford the car. Okay, so when interest rates go up, consumption is going to go down because people are going to find it harder to afford whatever they wanted to buy because the loans are going to be more expensive. It also incentivizes people to save because now instead of earning, whatever, 0.5% on your savings, maybe you're going to earn 3 or 4%. And so maybe you're like, hey, that's a pretty good deal. I can earn a reasonable amount of interest for my savings. If interest rates went to 8%, even more so, right? That's going to push people more towards savings, and it has the kind of inverse effect on consumption because now the loans are even more expensive in terms of interest costs. So you're going to buy even less or be incentivized to consume even less if you were planning on borrowing to make a purchase. Just like the interest rate is going to affect consumer behavior, it's also going to impact businesses. Okay, so when a business is deciding whether to build a new factory or invest in a new expansion project or decide whether they want to build a new office complex for their workers, the they're going to face kind of a similar trade-off that a consumer is that in that if they're planning on financing, meaning borrowing to do the project or make the expansion, then they may be more reluctant to do so as interest rates go up because basically their cost of capital is going to go up, right? It's going to take a higher, eh, if a project they kind of projected will give them an 8% return, if they made the investment, if interest rates are 8.5%, then the cost of borrowing exceeds even the return they're going to get on the investment. So they're not going to make the investment. Now, that's an extreme case where the return on the particular investment they were considering was lower than the cost of borrowing or the cost of capital. Because interest rates not only affect the cost of borrowing, it also affects the rate of interest, or sorry, the rate of return a equity investor is going to want. Okay, so let's say you're deciding whether to invest stock, meaning buying a particular ownership piece of a company versus lending. Okay, so if you could lend to the company, and again, lending is more safe because you will be the first to be paid back if something goes wrong. Let's say you could lend to a company at 8%. You're going to need to the potential to earn much more than that to invest in the riskier piece of owning stock in the company. Okay, so as interest rates, the cost of borrowing goes up. That's also going to affect the basically the price of equity too. Okay, so um, you're only going to invest in the company if you're, let's say, if the cost of borrowing was 8%. If you couldn't make more than, let's say, 12 or 15% buying the stock in the company, then you're not going to do it because you'd rather just lend at 8% and be in a safer position. So interest rates are also going to affect not only the ability for a company to borrow, but also issue stock because the price of a share of a company, it implies some level of return. Okay, so if you're investing $10 for 1% of a company, uh, if the stock price goes up to $15 and it's for that same 1%, you're going to get a lower rate of return, okay? Because now you're paying more for that 1%. So the stock price, basically, the company will have to basically offer a more desirable stock price, meaning a lower price to the investors. And companies don't like to do that. They want to issue their stock at the highest possible price, meaning giving the least percentage of their company to the investor to raise X amount of money. So if you watch Shark Tank, for example, they're always trying to, the sharks are trying to get, let's say the person on Shark Tank wants to get $100,000. The sharks are trying to get the highest percentage ownership for that 100,000, while the person raising the money wants to get the 100,000 but give the lowest amount of equity. So that's essentially what happens with interest rates. So as interest rates go up, companies will have to basically give up more of their company to raise a certain amount of money, and they don't like to do that. So the interest rate is going to definitely affect uh, business investment decisions. A project will have to be very juicy for the company to want to do it because their cost of capital has gone up. So interest rates and inflation are also tied together because inflation is largely a function of consumers' behavior. Okay, so I talked about how inflation is affected by, of course, the supply of money. So if you just injected $1 million into everyone's bank account, that's going to cause inflation for sure. However, it also is dependent on how much people are consuming. So even if you had the same money supply, if people are out there shopping more, willing to take on more credit to shop for things, that's gonna also create inflation. Okay, so by raising interest rates, a government or monetary policy decision maker can slow down the economy for all the reasons we talked about when it came to this point here. Because by raising interest rates, you're going to disincentivize people from spending money. So when you disincentivize people from spending money, it's going to lower inflation. Okay, so you can you can basically uh, slow inflation by slowing consumer spending, which involves raising interest rates. So in the last video, I showed you that that period of time where inflation was high in the 1980s, where interest rates are also very high. Now, the raising of the interest rates was in response to the inflation, and so the policymakers decided, hey, this inflation is out of control. We really got to slam the brakes on consumer spending and business investment, because really business investment also causes inflation, because businesses are competing for goods and services just like consumers are. So by raising the interest rates, they slowed down consumer spending, they slowed down business investment, and in that way got inflation under control by just kind of tamping down on demand. Now that has the effect of, being hard on people, and businesses. The businesses can't expand. They're they may have to defer certain capital expenditures because now it's so expensive to borrow. But if inflation is your primary concern, you can certainly control it by raising interest rates, which is, post COVID, after all the money printing happened, uh, the Federal Reserve decided that inflation was potentially going to get out of control and raised interest rates very, very aggressively. Okay, so that had some blowback for, especially in the real estate markets, where a lot of people had taken out loans initially at low interest rates, and uh, after rates went up a lot, their ability to refinance those loans was going to be very difficult. We're going to talk much more about real estate finance in another module, but again, this is kind of a related phenomenon where we had inflation kind of post COVID, and the interest rates were changed to compensate for that, and that had a big impact in the real estate market. And then finally, interest rates are used as a tool to smooth out economic cycles. So, economic cycles, we're going to spend a whole kind of module section on that. But it's basically, it involves the expansion and contraction of the economy. So, we have periods of expansion and growth, and then we have recessions. Okay, so there is a belief, there's an economic theory that you can basically make the recessions not as painful by doing certain things with your monetary policy, expanding the money supply, allowing the government to spend more money on programs to compensate for private sector, the businesses spending less, and you could smooth out the economic cycles by doing certain things with monetary policy, meaning the supply of money. Essentially giving money to the government so that they can spend it. Um, Lowering interest rates so that even though there's a recession and maybe there's a lot of people out of work, whoever does have a job can kind of spend more because interest rates are lower. So there's some belief that you can smooth out the cycles uh, that the economy goes through by using interest rates and manipulating interest rates. Now, has this worked out in the short term? You can argue many cycles, you could argue, have been smoothed out, but it's yet to be seen whether you're just sweeping things under the rug and there will be a very large correction to this whole thing down the line. Um, and the bill maybe is just getting deferred. So this is to be seen. This is to be seen. This is an open question, and history will say.